Dividend growth investing is a strategy in which investors seek out companies that have a history of consistently increasing their dividends over time. Dividends are payments made by companies to their shareholders out of their profits. Many publicly traded companies pay dividends to their shareholders on a regular basis, such as quarterly or annually, but in some cases even monthly. Investors like me who pursue a dividend growth strategy typically look for companies that have a track record of steadily increasing their dividends over time, as this can indicate financial stability and the company's ability to generate consistent profits. Investors like me are often seeking to generate a steady stream of passive income from our investments, rather than relying on potential for capital appreciation. To implement a dividend growth investing strategy, an investor might select a diversified portfolio of stocks that have a history of increasing their dividends. They might also consider factors such as a company's financial health, competitive advantage, and growth prospects when selecting stocks for their portfolio. Actually, Dividend Aristocrats may fit the bill really well here. Dividend Aristocrats are companies that have increased their annual dividend for at least 25 years. The good news is, we don't need to scan the entire universe to find those Dividend Aristocrats. The Dividend Growth Investors community is already doing this for us. One example is the Dividend Champions list from dripinvesting.org, and another example is my Noble 30 index at europeandgi.com. As such, in today's video, we are going to look at 5 Dividend Aristocrats to buy and hold for a very long time. These are companies with a proven track record of ever-increasing dividends, supported by a strong business model, a strong balance sheet, excellent management, and a decent starting yield. These companies have stood the test of time. They continued growing their dividends during the dot-com crash, the Great Financial Recession, and the more recent COVID-19 pandemic. Hence, this is strong evidence of their resilience, and it should set them up for many more dividend hikes in the years to come to help increase your passive income. Now, before we get started, if you're interested in seeing my own dividend growth portfolio, then check the link in the description of this video and sign up. You will then receive a link that will allow you to see my entire dividend growth portfolio, but also grab a dividend portfolio tracker template that allows you to track all your international dividend stocks, including all the dividend income. Hey, that's been enough of an introduction. Let's get started with the first Dividend Aristocrat to buy and hold for a very long time. And if you watch until the end, then you'll get a bonus dividend stock, which I believe will be a very strong future Dividend Aristocrat. So in my opinion, the first Dividend Aristocrat that we really need to talk about is Realty Income. This is an S&P 500 company dedicated to providing shareholders with dependable monthly income. The company is actually structured as a real estate investment trust, and its monthly dividends are supported by the cash flow from over 6,500 real estate properties owned under long-term lease agreements with their commercial clients. To date, actually, the company has already declared 608 consecutive common stock monthly dividends throughout its 52 years operating history, and it increased it about 109 times since Realty Income became public in 1994. And what I really like about this company is that they are really set up to support this monthly dividend income. As an example, their top 10 industries that they are participating in are really of defensive nature. Look at it. Grocery stores amounts for 10%, convenience stores, dollar stores, restaurants. So from that point of view, this company is really well diversified in its customer base. And we can also see that with their client diversification. Dollar General, 4.2%, the biggest client that they have. Walgreens, 3.9%. I know the business is a bit struggling from a share price point of view, but I don't see it going anywhere. So these are really reliable companies that make up their top 20 clients. And probably needless to say, this has also really positive impact in how they are doing as a business. And currently they are having a 53 billion enterprise value, and they have a strong upper grade credit rating of A3. And I personally like really strong balance sheets because it typically gives the company a lot of optionality to grow their dividends into the future. And look at this dividend growth. Since 1994, they had a 4.4% compounded annual growth rate in their dividends. And it currently pays around $3 in dividends per share. So having said that, in my opinion, this is a really strong Dividend Aristocrat. And why then do I think that it's reasonably priced? Well, currently it is trading at $64. This is around the 5-year average, I would say, if you look at it over time. So since 2019, it has gone effectively nowhere. Now, of course, as Warren Buffett always says, share prices can be for a very long time overvalued. So let's therefore have a quick look at some of the key statistics and the potential valuation for this company. So currently you can get realty income for 4.65% dividend yield, supported by 29 years of dividend growth, a 5-year CAGR of 4%, a price to funds from operations of a 20 multiple, and a payout ratio of 94%. Remember, REITs are obliged to pay more than 80% out of their funds from operations in the form of dividends. So having such a high payout ratio is typically normal for such a company. Now, if we look at the fair value, I believe that a company like Realty Income is just best valued by the dividend discount model. And if we take the dividend discount model into consideration and we apply a 10% discount rate and a 4% dividend growth, I believe that the company is worth around $50. Now, we just saw that the company is currently trading at around $64. Honestly, for me, even at these prices, I'm adding slowly to this company. I think it's still reasonably priced, and I do believe that Realty Income's dividend is very safe and will continue to grow in the next decade. The next Dividend Aristocrat, which I think is reasonably priced right now, is T. Rowe Price Group. This is a publicly owned investment manager. They provide an array of mutual funds, sub-advised funds, separately managed accounts, collective investment trust, and other related products. It provides it mainly to individuals, institutional investors, retirement plans, financial intermediaries, and institutions. Simply said, you can buy managed funds from T. Rowe Price at relatively attractive management fees compared to their peers. Now, I hear you think, isn't this company being outcompeted by index funds and ETFs? Well, the company realizes this, and it is very much aware of what's going on in the market, that there are fee pressures and such, but also that there is a value to growth rotation as part of the transitory factors. So they are taking all these factors into considerations and have actually a quite decent strategy to continue their growth effectively. So first of all, they want to grow their presence in the EMEA and APAC, so international expansion. But besides that, they're also just including ETFs and being in the competition with the likes of Vanguard. So from that point of view, let's see how they will develop on this. It's a slow compounder. This company will not go out of business overnight. Now, what they are currently being impacted by is their asset under management. Assets under management is probably the sole most important metric because a company like T. Rowe Price earn a fee based on the assets under management, let's say 0.5%. So if asset under management is declining, also their income will be declining and it will have an impact on their EPS. But look, so far these numbers have not been really hurting the company yet. The dividend is well covered and they have been growing their dividends already since 1986, which is an extraordinary long time horizon, and always their dividends were covered by the diluted earnings per share. So in my opinion, the dividend is pretty much safe, and if you have your doubts, then let's have a look at the financial health of this company via their balance sheet. As per the last quarterly earnings, they had $2.3 billion in cash on their balance sheet. And look at their long-term debt as a comparison here. They effectively have $320 million in long-term debt, which is effectively no debt at all. So they have more cash than debt on the balance sheet. And this is one of the best balance sheets that I currently know from any of the Dividend Aristocrats. So to sum it up, the dividend seems very safe because it's well covered by earnings and by a pristine balance sheet. But if you then look at the 5-year chart and what's happened, last year, November 21, it was trading at around $221 and now it dropped all the way to $111 today. That's a 50% drop. We saw the asset under management. They dropped about 20-25%. So in my opinion, we are seeing a really strong overreaction here of the share price. Yes, they are, forecasting a recession and everything. In my opinion, this is more than priced in. So let's have a look at some of the key statistics then. 36 years of dividend growth, currently a 4.27% dividend yield, which is really, really good in this market. A 17.3% 5-year annual dividend growth rate. I don't expect it to be the same going forward. They will be a bit more conservative, but I don't see a reason why they shouldn't be able to grow in the high single digits, let's say a 7-8% going forward. On top of that, a price to free cash flow of about 10 and a payout ratio of 42%. It makes this company just very attractive. If we then use a discounted cash flow calculation on top of that to establish the fair value of this company, I currently have it at a fair value of $146, and I'm using here a 12.5% discount rate because, money costs money, and this is the return I would like to see in a company of T. Rowe Price. Modeling a 2 billion, let's say, free cash flow as a baseline, and on average a 6% growth. I think these are quite conservative numbers, and that's why I find T. Rowe Price at the moment really attractively, even more than reasonably, priced as a dividend aristocrat. The next dividend aristocrat that I think is reasonably valued right now is Target Corporation. Target operates as a general merchandise retailer in the United States. The company offers food assortments, including perishables, dry grocery, dairy, and frozen items, and you get it. In other words, it's a company much like the likes of Walmart or Food Lion in the United States. What I like about this company is that it continues to grow and always innovates within their business. That's how they got to about 2,000 stores in the US, and they still have ample room to grow because currently their market share as per Q1 last year is still 2.8%, trailing Ahold Delhaize, Costco, Kroger, and of course the biggest of all, Walmart. But let's not be mistaken by the historical performance of Target. Look at their dividend growth history as well, all the way dating back to 1983. Continuous dividend growth, and this is actually the only dividend king on this list as well. A dividend king is a company that has 50 years of consecutive dividend growth. Just simply amazing. And not only that, they are also supported by a very strong upper class A2 long-term credit rating from Moody's. Now, all good so far, right? So if we then look at their 5-year share price performance, it's clear that it was really highly valued at $263 back in August 21, even in October and last year 21. Then suddenly there was a drop in May 22 and it continued to hover there around $152. Now what happened? It's actually fairly simple. Most of the grocery chains have been heavily impacted by inventory issues due to supply chain issues, and Target has not been a stranger to that. So in the latest quarterly report, this also resulted in lowered top-line guidance. This of course is not a surprise because the company reported third quarter earnings per share of $1.54, which is 50% less than last year around this time. So I'm not too worried about that because last year was an extraordinary year with really record profits. This year they had lots of inventory headwinds and supply chain headwinds, so they have to deal with it. They need to sit through it a little bit, but probably, and if we take guidance from the CEO, this should be behind them in the upcoming quarters. But if you want to know more about my full analysis on Target, it's one of the last videos that I've published before the end of last year. I go much deeper into the business here, so definitely check it out if you're interested furthermore. But if we look at the key statistics, I mentioned already, it's a dividend king, currently yielding 2.7%. This is around the bottom I have on my screener of 2.75%. They have a 5-year dividend compounded annual growth rate of 13%. I don't expect it to be the same going forward. I expected maybe a 5-6% for the next years, a price to earnings of 20, which is at the top level of where I like to see my companies in the multiples, and a payout ratio of about 60%. Now, if we look at my fair value here, it's $131. This is of course 10-12% less than where it's trading today. I derived this by using an 11% discount rate because it's a stable business, of a 4.2 million free cash flow as a baseline and a 4% free cash flow growth going forward. And full disclosure, I recently initiated position in Target for around $140, slightly above the price, but that's fine. This is a high quality business that I would really like to own at a fair price, and I intend to add more to my position on future price opportunities. The fourth dividend aristocrat that I would like to share with you that I think is reasonably priced is British American Tobacco. It's a company that provides tobacco and nicotine products to consumers worldwide. It offers vapor, tobacco heating, and modern oral nicotine products, customizable products, and traditional oral products, such as snus and moist snuff. The company has been founded in 1902, and it is a proud member of the Noble 30 Dividend Aristocrat list. Now, technically, British American Tobacco is not having 25 years of dividend growth, only 22, but I thought it really deserves to be in this list because it's just a matter of time that they will reach the status, and we are a little bit less strict when it comes to European dividend payers. Having said that, most of you that have been grown up in the 80s or the 90s really should recognize these brands like Pall Mall, Lucky Strike, and Camel. These are iconic cigarette brands that we all know, that we saw around us people smoking. But what I really like about British American Tobacco is that they are not stuck in the past. They have been heavily innovating over the last 15 to 20 years already. And in my opinion, they are leader in the new category space, which is all about reduced risk products towards their customers. For vapor, we're talking here about Fuse. And for tobacco heating, we're talking here about Glow. What is really interesting also is that they are in a patent battle with Altria and Philip Morris. And this has resulted in a big win for British American Tobacco because Altria is not allowed to sell their IQOS product until 2024. As a side fact, Philip Morris has recently purchased the rights from Altria to commercialize IQOS in 2024 in the US, which is really interesting because I call this the tobacco wars. Now, if we look then at their recent performance, everything is still going towards the right side and slightly up, which I really like. They are really focused in increasing the new category revenue. They have been doing that really well with a 45% growth. It's still not the same as the traditional combustible products, but they are slowly getting there. Revenue was up 3.7% at constant FX, and this is what we would like to see. But most and for all, what we really like to see is their cash return to shareholders, because they have been giving us 2.5 billion in dividends and 1.3 billion in share buybacks. And this, of course, is all done because they have a relatively good balance sheet for such a stable company like British American Tobacco of Baa2, confirmed by Moody's. But if we look at the 5-year share price development, it's still 30% down compared to where it was trading in 2018. It went all the way to a bottom of like £2.5, let's say, and currently it's trading about £3.3. Now the question is, of course, is like, why do I still think it's reasonably priced? So let's have a look at the statistics. Currently you can get British American Tobacco at a 6.5% yield, 22 years of dividend growth, and a 5-year dividend compounded annual growth rate of 7%. If you put those two together, you've got a really nice metric. Price to free cash flow is 7, which in my opinion is really low. I truly believe it should be rather trading at around a 10 multiple and a free cash flow payout ratio of 50%. So there's still room to grow for this high yielder. If we then look at the fair value, I believe it's worth £38, and I derive this using a 12.5% discount rate. I'm a little bit more conservative here because of the tobacco industry, but I'm using a 7.5 billion free cash flow baseline and a 5% growth going forward. Hence, it's currently trading at £33, so I believe this company is still reasonably valued as a dividend aristocrat. Well, the fifth dividend aristocrat that I believe is reasonably valued right now is DCC plc. DCC is a lesser known European dividend aristocrat from Ireland. The company was founded in 1976 and provides sales, marketing and support services worldwide, and they do that through 3 divisions: energy, healthcare and technology. As an example, the company's DCC LPG segment sells and markets liquefied petroleum gas, refrigerants and natural gas. But another example is their company's healthcare segment, which offers products and services to healthcare providers and health and beauty brand owners. Some of these services include the manufacturing and packaging of these products. In other words, a really well diversified business when it comes from a product catalog point of view. If we look at the profit by division, you can clearly see that DCC Energy is earning most of the profits, followed by healthcare and their technology segment. What I also really like about this company is that they are well diversified from a geographic point of view, because most of the profits come from continental Europe, but also the UK and the rest of the world. Having said that, what I really truly love about this company is what a compounder this is. Have a look at their operating profit over the last 30 years. Have a look also at their EPS. It's mainly to the right, onwards and upwards. But to me, The chart of charts is their dividend chart, which just continues to go flawlessly up. This is really why this company caught my attention and why I'm so happy of already owning some shares in this company. Now, if we look at the 5-year share price, it's down 44% since 2018. Of course, the energy sector was taking a large hit last year, also with the war in Ukraine. This is why this company continues to go down and it's currently trading at around £43. Now, I can tell you, I've been averaging down. I initiated the position around here in the summer of 2022, and I'm continued to average down. Now, why is that? Let's have a look at the last financial highlights from the last half-year report. I mean, revenue continued to increase, of course. You know, there was energy prices went up. Profit, however, also increased by 13% and 10% on constant currency, and also their adjusted EPS. This means also that their dividend continues to be covered very well. Hence, you know, this is why I love dividend growth investing and value investing. Fundamentally, the company continues to grow, but the market is pricing it currently much lower than where it was a few years ago. So how does it look then from a statistic point of view? Currently, you can get the company DCC at a 4% yield. With that, you get a company that has been growing the dividend for 31 years at an average compounded annual growth rate over the last 5 years, around 10%, a price to free cash flow of 16%, and a payout ratio of about 67%. Using the discounted cash flow model here, I believe this company is worth around £57. Therefore, clearly the company, in my opinion, is reasonably priced right now. I've derived this with a 12% discount rate, 350 million baseline free cash flow, and a 6% free cash flow growth. Hence, this was the 5th Dividend Aristocrat that I believe is really reasonably priced going into 2023. But hey guys, I also promised you a bonus company, and this just has to be Texas Instruments. If you don't know Texas Instruments, it's an American technology company headquartered in Dallas, Texas, that designs and manufactures semiconductors and various integrated circuits, which it sells to electronic designers and manufacturers globally. It was founded in 1930, and its current CEO is, in my opinion, one of the best, Richard K. Templeton. Their revenue is mainly derived from analog chip devices. It's approximately 14 billion out of the 18 billion, but its revenue is very well diversified via several key industries. What I really like about this company is how it thinks about its shareholders, because what they say here in their investors presentation is, we run the company with the mindset of being a long-term owner. We believe that growth of free cash flow per share is the primary driver of long-term value. I mean, that's exactly the philosophy that I have as an investor as well. And they've been doing that 12% free cash flow per share annual growth over the last, let's say, 16, 17 years. And this has also resulted in a 25% dividend compounded annual growth rate over that same period. And it currently pays about $5 in dividend annually per share. But as you know, I also like strong balance sheets and good credit ratings. Also here, this company has an upper grade credit rating of AA3 provided by Moody's. Now, if we look then at their share price development over the last 10 years, it was just compounding nicely, an 18% compounded annual growth rate for the share price, and it's currently trading at around $175. Now, if we look at the statistics then, currently the yield is 2.63%. It has 19 years dividend growth, and really, if we look at all of this data, in 5 to 6 years from now, hands down, this company will be a dividend aristocrat, unless there really happens an apocalypse in our world or really stupid management. But if we take history as a guidance, I can't imagine that. Having said that, the 5 years compounded annual growth rate in the dividend we saw already, a price to free cash flow of about 25, which is really on the rich side, and currently a payout ratio of 68%. Now, why do I still think it's reasonably valued? First of all, I believe that the free cash flow had a little bit of an impact over the last year, so I don't really see this as a problem. And when I look at the fair value using a discounted cash flow methodology, I believe it's fairly valued at around $166, which is slightly below the $175, using a 10% discount rate for such a high quality business, assuming a 6.5 billion free cash flow baseline and an 8% free cash flow growth. I think these are reasonable numbers, so expect me to continue adding into Texas Instruments as it dips at around, let's say, $160. For me, this is a high quality company that I would love to own for many years. So dollar cost averaging, guys, this is how I'm going to add to this company. But hey guys, thank you for staying so long with me. This concludes my video. These were 5 Dividend Aristocrats that I truly believe are reasonably priced right now, plus a bonus of a future Dividend Aristocrat called Texas Instruments. If you enjoyed this video, don't forget to hit the like button. If you're not subscribed yet, please subscribe yourself if you want to see more of this. And also, if you love it and you believe that other people should see this, just, share it on social media. All of what you can do helps me to continue growing this channel. Guys, I hope you enjoyed this one. Have a great weekend.